The paper price of silver just plunged 12% in after-hours trading last Friday, while physical bars in Shanghai vaults vanished at premiums exceeding 25% over spot. COMEX deliveries for December hit a wall, only 47% fulfilled, with refiners citing unprecedented strain on logistics chains. Meanwhile, the U.S. military's strategic stockpile of silver dipped below 18 months' operational needs for missile guidance systems and satellite arrays, a threshold not crossed since the Cold War stockpiling era. This isn't volatility. This is fracture. Banks triggered their kill switch, overnight margin hikes on futures contracts, designed to liquidate positions and crush upward momentum. It backfired. Physical demand didn't blink. It accelerated. Institutions pivoted to direct holdings, draining vaults faster than paper traders could short. The system, built on infinite leverage, just exposed its finite core. Look at the numbers stacking against the facade. Silver mine output flatlined at 813 million ounces for 2025, the fifth consecutive structural deficit, according to the Silver Institute, with industrial pull from solar panels and EVs devouring 1.2 billion ounces annually, a 48% overrun on supply. Yet futures prices got hammered down to $52 per ounce in that Friday session, even as Indian importers paid $67 spot for physical delivery, creating a backwardation curve steeper than during the 2021 squeeze attempt. Backwardation means spot prices eclipse futures. It's the market screaming scarcity while paper pretends abundance. Banks like JP Morgan, once notorious for their massive shorts totaling over 1 billion ounces equivalent in paper, flipped to net long in mid-2025, amassing 750 million ounces in physical bars. Why the reversal? Not benevolence. Their models cracked under real-world depletion. This is where logic breaks. A bank holding more physical silver than entire national reserves, yet colluding on rules to suppress the very asset they're hoarding. The kill switch wasn't subtle. CME Group, overseer of COMEX, jacked silver futures margins by 14% effective midnight last Thursday, echoing their 1980 playbook when they declared liquidation only on contracts during the Hunt brothers saga, vaporizing 75% of the price in weeks. Back then, it worked because physical infrastructure could absorb the reset. Refiners scaled, geopolitics stabilized post-Vietnam. Now, the mechanics fail. Global shipping routes, already throttled by Red Sea disruptions and Panama Canal droughts, delayed 32% of silver concentrate shipments from Peru and Mexico in Q4 2025. Add U.S. tariffs on critical minerals, slapping up to 50% on imports since silver's addition to the critical minerals list in September, and you get a logistics chokehold. Military procurement jumped 28% year over year, pulling silver into hypersonic missile coatings and quantum-resistant electronics amid escalating U.S.-China tensions over Taiwan. The Pentagon's quiet admission in October. Defense contractors like Raytheon face material shortages, delaying F-35 production by months. Not a footnote, a systemic rupture. If you've tracked futures margins in your trading setup and seen how these hikes disproportionately hit retail positions, drop your take in the comments. Does it feel like targeted suppression or just procedural noise? Peel back further, and the silence from regulators amplifies the signal. CFTC filings show bank short positions compressed by 40% since January, yet no probes into the coordinated margin spike that preceded last week's drop. Media coverage? Buried under tariff headlines and Fed speculation. This isn't oversight, it's complicity in a system where paper dominance once kept physical realities at bay. Historically, silver's dual role, industrial workhorse and monetary hedge, allowed banks to arbitrage the gap. In the 1970s oil crisis, silver prices tripled as inflation hedging, but banks reined it in via futures expansion. Post-2008, quantitative easing flooded paper markets, diluting physical signals. That era ends here. Demand isn't cyclical, it's structural. Solar installations globally hit 1.2 terawatts in 2025, requiring 140 million ounces of silver for conductive paste alone, a 22% increase from 2024. EVs? Tesla and BYD models embed 1 to 2 ounces per vehicle, with production topping 18 million units. Multiply that across geopolitics. Russia's silver exports, once 10% of global supply, halved amid sanctions, rerouting to China, which now stockpiles for its hypersonic arsenal. The inversion hits hardest in supply chains. Refiners like Asahi and Perth Mint reported allocation limits on 1,000-ounce bars in November, forcing buyers into smaller denominations at 15 to 20% premiums. This isn't hoarding hysteria, it's institutional flight to physics. Sovereign funds in the Middle East, quietly accumulating since 2023, accelerated purchases by 35% in Q3, per IMF data. Why? Because paper promises erode when vaults empty. Compared to the 1930s Silver Purchase Acts, when the US government vacuumed up global supply to back currency, stabilizing prices but creating artificial scarcity elsewhere. Today, the US military shortfall, down to 12 million ounces in strategic reserves against a 20 million ounce annual burn rate for defense tech, mirrors that, but without the backing authority. The system loses stability precisely here, where public policy collides with private manipulation, exposing that essential means irreplaceable, not interchangeable. Consider the behavioral anomalies among large players. Bullion banks, facing Basel III requirements tightened in 2025, must now hold more physical against derivatives. Yet, they opt for rule tweaks over compliance. Last week's margin hike forced liquidation of 28 million ounces in open interest overnight, but physical withdrawals from COMEX vaults surged 15% the following day. That's not capitulation, that's decoupling. In Europe, LBMA allocations for silver forwards showed a 9% default rate in settlements, the highest since Brexit logistics snarls. Geopolitically, this ties into broader fractures. China's dominance in refined silver, 28% of global output, aligns with its military buildup, potentially weaponizing exports in a Taiwan conflict. U.S. simulations from the Army University Press warn of mineral shortages crippling munitions in a prolonged war, with silver's conductivity unmatched for high-precision systems. The kill switch, meant to reset the board, instead accelerated the split. Paper for speculators, physical for survivors. If you're in defense contracting or supply chain logistics and have noticed delays in silver-based components, share your observations in the comments. What's the ground-level impact looking like? Trace the consequences upstream, and the picture darkens. Mine production declines aren't random. Primary silver mines, only 28% of supply, face or grade depletion, down 15% per ton since 2015. Byproduct silver from copper and lead zinc operations, 72% of total, suffers from base metal slowdowns amid energy transitions. Peru, the top producer, saw strikes and environmental shutdowns cut output by 8% in 2025. Russia and Mexico follow suit, with geopolitical risks layering on. This isn't growth stalling, it's capacity eroding. Banks' attempt to kill switch the rally ignored this, assuming infinite elasticity. But when physical seizures occur, as in Shanghai's 25% premium spike, futures lose authority. Historical parallel. The 2011 silver peak at $49, driven by industrial rebound post-recession, collapsed under similar margin hikes. Difference now? Demand is embedded, not emergent. Solar and EVs aren't fads. They're infrastructure mandates under net zero pledges, pulling 65% of silver offtake. The media blackout serves as its own indictment. While gold grabs headlines with 54% gains in 2025, silver's 71% run gets dismissed as volatility. No mention of the CFTC's increased enforcement on manipulation, fining two banks $45 million in Q3 for spoofing trades. Or UBS, forecasting $55 by mid-2026, citing physical tightness. This selective amplification keeps retail focused on paper dips, while institutions load vaults. The system's instability peaks at this disconnect. Regulators tweak rules to favor liquidity providers, read banks, but physical reality overrides. In 1980, the Hunt crisis ended with bankruptcy for the brothers. Today, the hunters are diffuse. Retail stacks via PSLV and direct bullion, amplified by social squeezes. Posts from traders flagged the margin nuke real-time, turning suppression into signal. If you followed historical silver crises like the Hunt era and see parallels or divergences in today's setup, weigh in below. How do you interpret the rule changes in context? Deeper into the weave, military dependencies expose the fragility. Silver's role in hypersonics, coatings that withstand 3,000 degrees Celsius, has no viable substitute. Alternatives like palladium cost 15 times more and face their own shortages. Pentagon reports from 2025 detail contested shipping routes, risking 40% import cuts in a US-China scenario, echoing World War II mineral blockades that delayed allied tech. Back then, systems adapted via synthetics. Now, quantum tech demands purity levels only silver delivers. Logistics amplify. Global freight rates up 22% due to Houthi attacks, delaying silver from South America to US fabs. Banks' kill switch, by crashing paper, inadvertently signaled to producers to withhold, tightening the loop. This nonlinear pressure, symptoms feeding causes, marks the phase shift. Institutions fleeing paper underscore the loss of control. JP Morgan's pivot to 750 million ounces physical isn't isolated. Citigroup and HSBC reported 25% increases in allocated silver holdings. Why hoard while shorting futures? Hedging against their own game. The 2025 backwardation episodes, where futures traded $3 below spot, flashed the warning. Paper systems fail when delivery demands exceed registered stocks. COMEX eligible silver dipped to 280 million ounces in November, against open interest implying 1.1 billion. A 4 times leverage that's sustainable only in abundance. Scarcity flips it. Compared to oil's 2008 spike, where physical tightness overrode futures manipulation. Silver follows, but with monetary undertones as inflation hedges resurface, amid 2025's 4.2% CPI creep. If you're an investor who's shifted from paper to physical silver this year, describe in the comments what tipped the scale for you. Was it a specific anomaly or broader system signals? The geopolitical layer cements the break. Tariffs on Chinese silver imports, enacted under the 2025 National Security Act. Reroute flows, but at higher costs, up 18% for end users. This isn't protectionism working, it's acceleration of depletion. In a mirror to the 1970s, when OPEC weaponized oil, silver could become the next choke point in tech wars. U.S. forces, already strained by Ukraine aid draining munitions, face silver as the limiting factor in restocking. Reports from Defense Industrial Base assessments. 62% of contractors cite critical mineral constraints as top risk, with silver leading. Banks' failed kill switch? It exposed that financial controls can't override physical laws. The overnight rule change, meant to deter squeezes, instead ignited delivery runs. Unpack the behavioral shift among players, and the fracture widens. Retail traders, scarred by 2021's failed squeeze, now bypass brokers imposing suitability limits on physical trusts like PSLV. X threads lit up with warnings. Physical for them, paper for you. This democratized pressure erodes bank dominance. Historically, crises like 1933's gold recall centralized control. Now, decentralization via vaults and ETFs fragments it. The system's sustainability cracks where leverage meets limit. Infinite paper claims on finite atoms. If you've encountered premium spikes or allocation limits when buying physical silver recently, share your experience in the comments. Does it match the reported anomalies or show regional variations? Finally, the consequences cascade. Supply deficits project to widen in 2026, with mined output forecast down 3% amid ESG restrictions on new projects. Demand? Solar alone projected at 160 million ounces. EVs another 40 million. Military needs, if tensions escalate, could pull 30 million more. Banks, having messed their kill switch, now face margin calls on their own positions as physical premiums persist. The phase is set, not collapse, but reconfiguration. Paper recedes, physical asserts. The process unfolds without fanfare, but with inevitability. The quiet depletion that reshapes everything. If you're analyzing broader commodity markets and see silver's disconnect influencing other assets, post your interpretation in the comments. What chain reactions do you anticipate? COMEX registered silver inventories drained by over 47 million ounces in the first 4 trading days of December 2025 alone, wiping out more than 60% of deliverable stock, while open interest implied claims 4 times higher. Shanghai vaults hit a 10-year low at just over 531,000 kilograms, even as spot premiums in Asia spiked to levels unseen outside crisis periods. Futures prices climbed to $68 per ounce by mid-December. Yet physical delivery demands accelerated, with backwardation stretching across the curve. December contracts trading discounts to spot exceeding $2 at peaks. CME responded with a 10% margin hike on silver futures, effective December 12th, forcing liquidations that briefly capped the rally but failed to refill vaults. This isn't correction, this is rupture. Banks deployed the kill switch again, echoing 1980 and 2011. But the physical layer refused to yield. The mechanics that once contained silver no longer hold. Mine production stalled near 813 million ounces for 2025. The Silver Institute confirming a 5th straight structural deficit projected at 95 to 117 million ounces, driven by industrial offtake hitting records. Solar alone pulling 232 million ounces. Amid terawatt-scale deployments, EVs embedding 1 to 2 ounces per unit across 18 million vehicles. Recycling edged higher, but couldn't bridge the gap as high-grade scrap dwindled. Yet JP Morgan, after closing a decades-long short position exceeding 200 million ounces equivalent, amassed over 750 million ounces in physical holdings by late 2025, controlling vaults that dwarf national reserves. Their reversal wasn't charity, it was survival. Models built on leveraged paper cracked against embedded demand, no longer cyclical, but infrastructural. Net zero mandates, data centers, hypersonics, all consuming silver without substitute at scale. Regulators stayed silent as the hike landed. CFTC filings showing concentrated longs compressing shorts without scrutiny. Media fixated on gold's steadier climb, bearing silver's 120 to 140% annual surge under broader commodity noise. This quiet complicity marks the break. Systems designed for abundance now confront finite atoms. In 1980, margin spikes and liquidation-only rules crushed the hunt squeeze because refiners could ramp and imports flowed freely. Post-2008 expansions diluted signals further. Today, Red Sea routes disrupted, tariffs layering 25 to 50% on critical inflows. Peru's output down 8% from strikes. Elasticity vanished. Military pull, hidden in electronics budgets, but vital for guidance systems and batteries, compounded the strain, with reports of contractors facing delays akin to contested logistics in war games. If you've navigated physical purchases amid these premium spikes and seen regional differences in availability, share the details in the comments. What patterns emerge on the ground? Trace the inversion's depth, and the system's fragility sharpens. Backwardation hit extremes not seen since 1980, with front-month discounts signaling immediate scarcity overriding carry costs. Lease rates spiked above 30% at points. Borrowers paying premiums for metal that simply wasn't there. Institutions didn't retreat. They doubled down on allocated holdings. Middle East funds up 35%, ETFs absorbing 95 million ounces in the first half alone. COMEX outflows continued post-hike, eligible stocks bleeding as metal migrated to private vaults. Compared to 2011, industrial rebound drove a brief peak, but margins reset the board amid ample above-ground buffers. Now buffers erode. Global inventories tight. Byproduct supply from base metals constrained by energy shifts. The kill switch, intended to purge speculation, instead broadcast weakness, accelerating the flight to physics. Geopolitics layers the pressure without mercy. China's refining dominance, paired with export rerouting amid sanctions, positions silver as potential leverage in tech confrontations. Hypersonics and quantum systems demanding unmatched purity. U.S. import reliance, pegged 64 to 80% by USGS, collides with tariffs and contested shipping, echoing World War II blockades, but without synthetic alternatives at scale. Defense assessments flag critical constraints. Munitions production, hinging on conductivity, no palladium or copper replicate economically. Banks' pivot, JP Morgan's hoard, others following. Hedges their own exposure, acknowledging paper authority fading. The overnight hike liquidated positions, yet withdrawals surged the next day, decoupling complete. If you're tracking lease rates or EFP spreads in your analysis and spot shifts from historical norms, drop your readings in the comments. How sustained does this inversion look? Upstream, the erosion accelerates quietly. Primary mines, just 28% of output, suffer grade declines, down 15% per ton since 2015, while byproduct streams slow with copper's green transition drag. ESG barriers stall new projects, Russia and Mexico rerouting under sanctions. Demand embeds deeper. Solar conductive paste alone forecasts 160 million ounces in 2026. Military needs potentially 30 million more if escalations hold. The margin tool, once effective reset, now fuels the narrative. Suppression signals scarcity, drawing more takers. Historical crises centralize control. Today's decentralization via direct bullion and trust fragments it, eroding dominance. Behavioral shifts among players expose the loss. Retail, bypassing suitability checks, stacks PSLV and coin. Institutions load vaults while regulators avert eyes. Premiums on 1,000-ounce bars hit 15 to 20%. Refiners allocating smaller units. This isn't panic buying, it's rational repositioning as paper promises strain against delivery realities. In Europe, settlement defaults rose. LBMA, tightness persisting. The phase marks reconfiguration. Leverage meets limit. Infinite claims on finite resource. If you've observed changes in refinery allocations or bar sizes available through your channels, note it below. Does it align with reported tightness or vary by region? Consequences cascade without resolution. Deficits widen into 2026. Mine growth marginal at best 2 to 3%. Industrial mandates, EVs, AI infrastructure, pull relentlessly, military contingencies layering unpredictability. Banks, post-misfire, confront their positions as premiums endure. Paper recedes not from decree, but depletion. Physical asserts primacy. The process advances steadily, reshaping allocations, priorities, controls. Systems fracture not in spectacle, but accumulation. The quiet signals compounding into irreversible shift. The fracture is here, sustained, defining the terrain ahead. If you're mapping broader commodity flows and anticipate silver's signals rippling into energy or base metals, outline your view in the comments. What interconnections stand out? COMEX registered stocks plunged below 100 million ounces by December 20th, 2025, with over 60% of remaining deliverable silver claimed in frantic settlements, while Shanghai Gold Exchange vaults scraped decade lows at 531,000 kilograms, barely 17 million ounces. Despite relentless exports westward, futures prices spiked past $69 per ounce on December 22nd, yet physical premiums in Asia held firm above $1.40, with lease rates flashing 30% annualized at peaks. CME layered another margin hike on December 12th, lifting initial requirements to $22,000 per contract, a 10% jump, forcing scattered liquidations, but vaults emptied faster. This isn't rebalancing, this is exhaustion. The kill switch, fired repeatedly, now ricochets, amplifying the very scarcity it aimed to contain. The fracture deepens without reversal. Silver Institute projections locked a fifth consecutive deficit at 95 to 149 million ounces for 2025, with industrial consumption. Solar paste alone devouring 232 million ounces amid terawatt deployments. Overrunning mined output stalled near 813 million ounces. Recycling couldn't close the breach as scrap grades thinned. JP Morgan, having liquidated a historic 200 million ounce paper short mid-year, consolidated over 750 million ounces, physical by December, dwarfing exchange floats and signaling institutional recognition. Paper containment fails against embedded flows. Backwardation persisted across months, front contracts discounting spot by up to 60 cents at extremes. A scream from the physical layer that futures pricing lost authority. Silence from oversight bodies compounds the signal. CFTC monitored concentrated longs without intervention as hikes landed, while coverage fragmented across geopolitical noise. In 2011, similar spikes reset amid buffers. Today, those buffers, global above-ground stocks drawn down cumulatively 800 million ounces since 2021, offer no cushion. Tariffs rerouted metal, contested routes delayed concentrates, Peru and Mexico output lagged, supply elasticity evaporated. Military and tech dependencies, from hypersonics to data centers, layered non-discretionary pull, no thrifting viable at scale. If you've dealt with lease rate spikes or settlement delays in your operations this month, outline the specifics in the comments. How deep does the tightness cut on your end? The decoupling accelerates quietly. Institutions migrated holdings to allocated vaults. ETFs absorb surges. Yet COMEX outflows post-hike signaled migration complete. Historical reset centralized. Now diffusion via direct channels erodes that grip. Premiums on wholesale bars locked 15 to 20%. Refiners rationing forms. Geopolitics embeds the constraint. China's refining lock, potential export curbs and escalations. US reliance colliding with policy walls. The margin tool, once blunt reset, now advertises vulnerability. Liquidations feed delivery runs, tightening the coil. Consequences compound into 2026 without relief. Deficits forecast wider. Mine increments marginal 2 to 3%. Demand relentless from mandates. Banks confront their hedges as premiums endure. Paper influence waning, not by decree, but depletion. The phase solidifies. Physical primacy over leveraged claims. Reconfiguration not in chaos, but steady erosion. Systems lose grip where finite meets infinite promise. The quiet drain reshaping control, allocations, realities ahead. If you're projecting 2026 deficits against these inventory trends and see shifts in industrial or investment flows, share your breakdown in the comments. What variables tip the balance for you?